welcome to the deep dive. If you're looking at the U.S. stock market right now, well, you're seeing something pretty contradictory. It's early October 2025, S&P 500, the Dow, they're hitting all-time highs. But the U.S. government is shut down. All that crucial economic data we rely on, frozen. So our mission today is to really dig into this split, understand why the market seems so resilient while, acknowledging these mounting risks that maybe aren't getting enough attention. We need to figure out what's actually holding this thing up.
Yeah, it's fascinating. And this market strength, it isn't just random. It seems anchored by, well, three key things. First, there's this historical playbook, right? Investors are kind of conditioned to see shutdowns as just, temporary political noise. Second, you've got really solid corporate earnings holding things up fundamentally, especially all the excitement around AI. And third, the Fed's being very accommodative. They already started cutting rates last month, September.
Okay, let's talk about that historical complacency. History says don't worry, but why might this shutdown be different? I mean, compared to the 90s ones?
Well, the market tends to shrug it off because historically it pays to ignore the drama.
Yeah.
The S&P 500. It's actually gone up during every single government shutdown since 1990. And maybe even more telling, the index has averaged something like a 13% to 14.5% return in the year after things get resolved. Pretty strong.
Right, but that historical script, it doesn't factor in this new element, does it? The administration is talking about permanent layoffs this time, not just temporary furloughs. That feels like real economic damage that maybe isn't priced in.
Exactly. That's the political curveball. But the bedrock support is still earnings. Q3 forecasts for S&P 500 earnings growth still looking strong. We're talking projections of like plus 5.5% to maybe plus 7.9%. And that's overwhelmingly pushed by the Magnificent Seven tech giants. And this just relentless narrative around AI dominance. That story seems powerful enough to, well, paper over the political chaos. For now, at least.
Okay, let's switch gears to the dangers lurking underneath, starting with valuation. How stretched are we, really?
We are seriously stretched. Leaves almost no room for things to go wrong. If you look at the Shiller KP ratio.
The cyclically adjusted PE, right, smooths things out.
Exactly. It smooths earnings over 10 years, gives a better long-term picture. It's currently sitting around 37.1.
Wow. That's... What, 80% above its average since 1950? That number alone feels like a warning sign.
It definitely puts the market in the strongly overvalued category, historically speaking.
So if valuation offers no safety net, what's the most immediate policy risk? I guess that brings us to this data blackout.
This is probably the biggest immediate risk, yeah. The market has basically priced in like a 98% chance of another Fed rate cut later this month. It's almost a certainty in investors' minds. But with the shutdown delaying jobs reports, inflation data, the Fed's essentially flying blind. They could easily be forced into what the market would see as a hawkish surprise. Maybe they pause, maybe they skip the cut because they just don't have the data.
And that would shock the market.
Instantly. It would force a huge repricing of risk.
And zooming out a bit, the wider economic picture isn't exactly rock solid either, which makes that potential Fed mistake even more dangerous.
It really isn't.
Yeah.
We're already seeing signs of a weakening labor market, and inflation is still sticky. The CPI, the Consumer Price Index, is still up near 2.9% year over year. And crucially, you have the administration's pretty aggressive trade tariffs. The effective rate is now over 15%. That seriously risks triggering a stagflationary shock.
Stagflation. So slow growth and high inflation, which basically kills the old reliable Fed put, right? That idea that the Fed can always step in and save the market.
Precisely. When you've got inflation running hot but growth flowing down, the Fed gets caught. Its mandates conflict. They can't easily cut rates to boost the economy or markets without potentially making inflation even worse. So that traditional safety net is kind of neutralized. So putting it all together, the market right now is priced for, well, basically the absolute best case scenario.
A perfect landing.
Yeah, like a quick shutdown resolution. The Fed navigates perfectly despite having no data, and AI keeps driving earnings indefinitely.
Okay, if that's the situation, let's bring it back to the listener. How should you be thinking about this risk profile right now?
Well, look, the risk-reward balance, it seems to have shifted quite a bit for the worse. The biggest danger seems to be this convergence. You've got the policy uncertainty, the data blackout, potentially causing a Fed error, smashing into that potential stagflationary shock from trade policy.
Right.
That kind of scenario. It almost inevitably forces what we call PE multiple contraction. Investors just suddenly refuse to pay these high prices for earnings anymore. And that could easily trigger a pretty sharp correction, maybe 10% or even more.
So here's a final thought to leave you with. We know this market rally is actually helping prop up consumer spending through the wealth effect, right? Like people feel richer, they spend more. What's the real economic cost if these stretched, overbought market conditions collide with a policy mistake, leading to a sudden, messy sell off and deleveraging? That's a critical question we should all be exploring.